Welcome, everyone. Today, we will learn together a very new account designed by Canada Revenue Agency. It's called First Home Saving Account. It's so new that even I ask those product providers from our company, sometimes they say, well, they are also learning about this. So we will learn together. 首次购房存款账户哈，用中文翻译就是。So let's put this account into the spectrum or the account types in this list. So we all know the banking accounts, right? It provides us liquidity. Checking account, we have a cash flow in, cash flow out, pay the bill. We have a saving account, we save some money for the emergency funds. Other than those daily accounts we deal with, we also have many saving and investment accounts. And those are the accounts designed by Canada Revenue Agency. And today we'll focus on First Home Saving Account. It's new account that it just start the implementation on April 1st, 2023. In the previous webinar, we discussed about RSP, RESP, RDSP, and so on, and non-registered account. And so you can also go back to our YouTube video to learn about the other accounts. All right. So as our habit, we make it as a workshop. So when I finish my sharing, and everyone can open mic and feel free to ask questions to get better understanding. Okay. So today's agenda. Number one thing, we need to understand what is First Home Saving Account. So in the short form, FHSA. And number two, what are the benefits of using FHSA? Number three, what are the investments choices for this account? So the first topic, what is First Home Saving Account? I would like to share with you first the resources. It's all from Canada Revenue Agency website. So tonight, I pretty much just help everybody to understand the information from this website. What is FHSA? First Home Saving Account. This program started brand new last month, April the 1st, 2023. What's the purpose to design this account? It is a registered account allowing you and the prospective first home buyers to save for your first home tax-free. Up to a certain limit. So the maximum contribution room will be $40,000. Who can open this account? So here the eligibility criteria. The individual who turn 18 and older, so mainly like adults, and a resident in Canada, have a valid social insurance number, and is a first-time home buyer. Please take note that the definition of a first-time home buyer is different when the person opens an account and at the point of withdrawing from this account. So let's look at this in more details. At the time of opening this account, who is considered as a first-time home buyer? So this person, he is not owning or not jointly owning a principal residence, or his spouse or common law partner doesn't own or joint own a property. Then this person will consider as a first-time home buyer at the time of opening an account. Then at the time of a withdrawal from this account, and this will be considered a first-time home buyer if the person at any time in the same calendar year doesn't own a home, or in the preceding 4 calendar years doesn't live a qualified home. He doesn't have his own principal house, okay, or jointly own a property with his spouse, common law partners. Then at the time of withdrawal, this person is called first-time home buyer. So how to manage this account? When we open an account, then we will save and invest money into this account. Then later on, we will withdraw from the account and close the account. Okay, so there are three types of FHSA. Number one, a depository FHSA. So this is an account you open with a financial institution. You can put in cash, term deposit, or GIC. So it's a very safe investment, pretty much like a holding cash, right? Number two, a trusted FHSA, a trust with a trust company as a trustee that holds qualified investments such as money, cash, term deposit, GIC, government and corporate bonds, mutual fund, and securities listed on the designated stock exchange. So you have a variety of choices. Or number three, an insured FHSA. So it's an annuity contract with a licensed annuity provider, mainly insurance companies. So if you would like to know more about this, later on, I'm going to show you some examples. What are the investment choices you can open an account with bank, with insurance companies, or any other credit unions or trust companies. Then the last stage will be withdrawal from this account. There are different types of withdrawal. At this point, need to be very aware which type of withdrawal will be tax-free and what form of withdrawal will be counted as a taxable income, right? So here, a withdrawal from FHSA is not required to be included in your income tax if it is, number one, qualifying withdrawal, number two, a designated amount, or an amount otherwise included in your income. So we will show you some examples, okay? And withdrawal from FHSA. So number one, this one will be tax-free. We call it qualifying withdrawal. So let's read this paragraph together. There's some conditions to be met. Number one, you must fill out the form RC725 at the point of a withdrawal. Number two, must be the definition of first-time home buyer at the point of withdrawal. Number three, you must have a written agreement to buy or build a qualifying home with the acquisition or construction completion date of the qualifying home before October the 1st of the year following the date of the withdrawal. So pretty much we say, well, in the same calendar year. Then you must not have acquired the qualifying home more than 30 days before making the withdrawal. So you do need to qualify first, then making the withdrawal, okay? You must be a resident of Canada from the time that you make your first qualifying withdrawal from one of your account until the earlier of the acquisition of the qualifying home or the date of your death. What does that mean? You need to be the residents of Canada, okay? The last one, you must occupy or intend to occupy the qualifying home as your principal place of residence within 1 year after buying or building it. So the purpose is that you want to own this home mainly as your principal house, not as like an investment property. So the second way of withdrawal is called designated amount. So let's read this paragraph together. The amount of assets, FHSA amount, that is either withdrawal from your FHA or transfer from your FHA to your RSP RIF using a prescribed form. The prescribed form will be available at a later date, because it's so new, right? Remember this, a designated amount cannot exceed your excess FHSA amount at the time of designation. So pretty much why we need to use this like withdrawal, because there will be some excess amount that you want to either take it out or you want to transfer to your other registered account. So let's look at the example. Designated withdrawal means what? Take the money out of this account, right? So you want to take the excess money out of this account, but also need to meet following requirement. So how much you can take it out? Number one thing is the total amount contribute to your account. Then you need to minus any amount previous withdrawal as a designated withdrawal. It's more like whatever is left over in this account that you can take out, right? Another way is designated transfer. Transfer to where? I have excess amount. I need to transfer to my registered account. Could be RSP or RIF. Those are the pension. You save the money for your own pension, right? Again, how much you can transfer? So the amount is the total amount transferred from your RSP to your FHSA minus any amounts previously transferred as a designated transfer. Okay, so it's very easy to understand in a way that before you transfer some RSP into this account, whenever you would like to transfer back, you could not exceed that amount. And when to close the account? So there's different scenarios. The maximum participation period begins when you open your first FHSA and ends on the December 1st of the year in which the earliest of the following event occurs. So those are the three events. Number one, the 15 years anniversary of opening your first account. So you can hold this account for 15 years. Or you turn 71 years of age. Or you make your first qualified withdrawal. Pretty much at that time, you say, oh, I already find a very, suitable property for myself, the real estate, and then I need to take this amount out as a down payment, right? In order to avoid unintended tax consequences, you should close all of your FHSAs before your maximum participation period ends. So you say, well, you don't keep any amount left there. Otherwise, the amount left in the account will be taxable. Now, the second topic, why we need to open this or we hold this FHSA account. So we need to understand the benefits, right? So let's just take a summary of the benefit, and later on, I'm going to give you some examples. Number one thing is really the government decided this account to help the Canadians to meet their financial goals. So they can save and invest money, then they can have enough money to take it out as a down payment so they can buy their first home. So that's the purpose of this account. Number two, qualified adults can participate. For example, your children is a young adult, let's say 20 years old, and he can open this account. FHSA contribution room accumulated without expiration. So you can accumulate. If you say, well, I know this account, but right now I did not open it yet. I did not contribute yet. So all the rooms will be accumulated. Later on, I'm going to show you how much is the contribution room each year. Then another one, contribution room is not related to annual income. So everyone will have 8,000 per year. It's a contribution room. Doesn't matter you make how much income each year. Cash contributions to this account are tax deductible. So we calculate this tax deductible within the calendar year. Means what? January 1st till December 31st. Qualifying withdrawals are not counted as a taxable income. So it's a very, sensitive in a way. When the person starting to withdraw the money, we do need to consider what way to withdraw that will be not counted as a taxable income. So you do need to have a financial advisor to give you the guidance. And when you invest into this account, there are multiple choice of investments. You can have a diversification. So the third topic I'm going to share with you, what could be the holdings in this account. Designate beneficiary when open a FHSA account. Okay, so you already prepare for like a long term. Close account at the year 15 or turn age 71, whenever it comes first. So it means what? A person have a sufficient investment timeline. And of course, when you are making the qualified withdrawing, and then it will be tax-free. So now let's look at more details. What are the pros and cons of this account? Contribution that you made to your first home saving accounts are generally deductible on your income tax and benefit return. So let's say I make 8,000 contribution to this account, cash farm, and that it will be deductible from my income tax. It is important to know that transfer from your registered account to this FHSA account are not deductible. Why? Because you already use this RSP to do as a tax deductible, right? So it will not do it like a double tax. That is what it means. What are the cons? Of course, when you have an account, there always will be administration fees related to that account to manage this account. Any contribution to your account that exceed your lifetime limit, which is 40,000, cannot be deducted on your income tax and benefit return for any year. Means what? There's a cap. What's the cap? The maximum deductible will be 40,000 in your lifetime. Be very careful not to contribute too much into this account, because if you contribute more than 40,000, then you will have to pay a tax of 1% of the highest excess FHSA amount in the month of each month until the excess FHSA amount is eliminated. How you eliminate that excess amount? Like you contribute more than the limits, either by qualifying withdrawal or designated withdrawal or transfer that we discussed earlier. Okay, let's look at the numbers. So it's easier to understand with the numbers, right? Number one thing is universal for all the qualifying adults, young adults, who can make a contribution into this account 8,000 per year. So that's the maximum of each calendar year. Means what? January 1st to December 31st. And the lifetime limits is 40,000. And the contribution can be made by cash deposit, or you can transfer the amount from your RSP that will consider tax deductible. Let me give you examples. Juliana, total contribution of 500 cash, and also transfer 7,500, did not access her FHSA participation room for 2023 because 500 plus 7,500 equal to 8,000. So it's just like within the limits, right? And this one, 7,500, she can take it from her RSP and transfer into this account. And she can also make 500 cash deposit into this account. So altogether, 800 will be her contribution for this year, 2023. Remember, 7,500 will not be deductible again because RSP has already been tax deductible. You already used this once. You should not use this twice. However, she has like a 5,000 extra, like a new money to put into this account. This will be deductible for this year, 2023. And then we also look forward for the next year. How much room she will have? She will have 8,000, right? She hasn't made any deposit yet. After calendar year, January 1st, then she can start to contribute 8,000. That will be counted in the year of 2024. So we just like rolling the ball like this. Each year, you have 8,000 maximum contribution rule. And now let's look at how much we can deduct from our current year's income tax, right? And we will say it's like manage this account. We can simply say, well, if everybody understands RSP, how it works, or tax-free saving account, how it works, a lot of times I can see that it's a little bit more like a combination of both, right? So let's look at the numbers. The maximum amount that you may deduct in respect of your FHSA contribution is the lesser of, okay? Either or, okay? Depends on the scenario, right? On the left-hand side, the total of all your annual FHSA limits, so this is 8,000, for the year and each prior year. If you already accumulate, you might have more. But now we are in 2023, so we don't have more than 8,000 at this point. It will minus the total of all your FHSA deduction for each prior year. All right. So what it means is that if you already use the amount for the tax deduction, you will not use it for the second time. You only can use the fresh money you deposit into this year. You deduct your income tax for the current calendar year. Okay. The other scenario, we look at the maximum, like a lifetime is 40,000, right? And we need to minus the total of all your FHSA deduction for each prior year. So you already use that amount for deduction, you will not use it another time. That's what it means. Also minus all amounts transferred from your RSP to your FHSA for the year and each prior year. What does that mean? RSP already used for the purpose of tax deduction. Again, we could not use it for the second time. That's why you need to minus those two amounts. Okay, so if the result of this calculation is negative, of course, we use 0, right? So let's look at the timeline, how you will deduct this amount, right? So remember one word, the key word is a calendar year, January to December, okay? So let's look at 2023. So now we are here in the year 2023, April 1st, is the first day you can implement this account, okay? Until December 31st, how much room we have? We have 8,000. And then, of course, this year is cut short because the first 3 months is already gone, right? And so if we open this account in 2023, so we can make the deduction, the contribution period, okay, is from April 1st to December 31st. And this will, all the amount you deposit during this time period will be considered tax deductible, okay? Remember one thing, do not mix this up with RSP. RSP is a bit special, you know what? Because the RSP usually give you 60-day rule. Means what? This calendar year finished, December 31st passed. But the first 30 days of the next calendar year, whatever you put into the RSP could be tax deductible, but it's not the cases of FHSA. Okay, here just give you some comparison to help you to understand what's the difference between FHSA and RSP. Now we are talking about the timeline. Give you an example, it will be easier to understand, right? Arena opened her first FHSA in 2023. She did not make any contribution to this account that year. Means what? You can open an account, but you don't need to deposit any dollars, right? However, the next year, January 15, 2024, Arena decided to contribute 5,000 to her account. So she wanted to claim her 5,000 contribution as the FHSA deduction on her year 2023 income tax, similar to RSP contribution. Can she do that? No, right? Because we talk about that. We say it's really the calendar year can be count. So it's not like the first 60 days contribution doesn't count. Therefore, her contribution, 5,000, into this account will be counted as a tax deductible only for the tax year 2024. Okay. Next, the second example. Contribution made after the first qualifying withdrawal. Let's say, this person opened an account, accumulate a certain good amount of money, and already find a good property that he would like to purchase the first home, and he take out the money, right? So remember, after the qualifying withdrawal, means what? Already taking out the money to buy the new home. Then this contribution cannot be deducted on this person's income tax. All right. So here, look at the example. Clayton opened his first FHSA account in this year, 2023, and contributed to $8,000 in each year. Let's look forward. Okay. Next year and 2025, Clayton claimed an $8,000 FHSA deduction on his income tax and benefit return for each year. That's correct. There's no problem, right? Then he filled out the form RC725. Means what? He is ready to make the qualifying withdrawal and gave it to his financial institution in August 2026. That's the year he buy his first home. And then the withdrawal was deposited into his bank. Now, in December 2026, Clayton contribute $8,000 into his FHSA. Means what? He take out the money August 2026, but after that December he contribute again another $8,000 into this account. So here's the part we need to pay attention. Since Clayton made his first qualifying withdrawal in August 2026, he cannot claim his $8,000 contribution from December 2026 as FHSA deduction on his income tax and benefit return for 2026 for any subsequent years. So remember this very, very well, because after you made the qualifying withdrawal, whatever the contribution you made, the following years, it will not become tax deductible. So it means what? You lose the tax deduction benefit. Okay, so this is a very important to remember. Now, a lot of people say, I can accumulate unused contribution room. Is that right? What happened to those rooms? So the great things from here, it can carry forward. For example, 2023, I have a room 8,000. 2024, another 8,000. 2025, have another 8,000. But I never use those amount, right? So they can carry forward. In the year of 2026, if I would like to open an account, and now you have 8,000 3 times plus 8,000 in 2026, 4 times. And then you will have all the room 32,000. Okay, so this is, you will not lose the room that you haven't been used. Okay. And where to check your unused contribution room? It will coming from your Canada Revenue Agency Notice of Assessment. So if you have a My account with Canada Revenue Agency, like an online account, and you can check. Not available right now because it is so new, but at the end of this year or next year, you'll be able to see it, okay? So number 3, what are the investment choices for FHSA account? Means what? Now I open an account. Now what? How can I save money, make money, grow my money, right? So this is a big topic, and this is our specialty. Number 1 thing, I always remind everyone, the type of account is not the same as the investment products, okay? So what does that mean? You open an account just like you have a cup, you're holding cash, this is a water. If you're holding, for example, like a bonds, let's say it's a coffee, or you say, I like tea, that could be stocks, okay? So open an account, it's just like a container, okay? But the investment productions could be like a water, coffee, or tea, okay? So let me show you what are the investment choices, okay? So the type of permitted investment are very similar like those accounts, RSP, tax-free saving account, RESP, RDSP. Okay. So now let's look at what could be the holdings in this account, right? You can open an account, you put in cash, you don't invest anything, okay, money. And you can put into you can purchase bonds, like a government bonds, T-bills, or the corporate bonds. A lot of people say, well, I can put into the GIC, or you can hold mutual fund or segregated fund, or you can buy stocks and annuity. Okay, annuity is available in the insurance company. So let me give you some comparison. So which one I should choose, right? A lot of people get so confused. So let me help you to understand two major things: mutual funds or segregated funds. Those are the same as a diversified investment. So the funds, you always remember one thing: they are a combination of bonds and stocks. Okay, so when we open an account, save and grow money, we would like to grow our wealth, right? But where to grow wealth? And also we say, well, we need to see what are the institutions we can open an account. Mutual fund usually will distribute it by bank or the mutual fund companies. Segregated fund are distributed by insurance companies. Okay, so let's compare the difference between those holdings. The mutual fund doesn't have a guarantee at the maturity day or upon death. And there's no reset function, could not bypass probate, and there could be a lot of like a surrender, accounting legal fees when the person passed away. And there's no privacy and no creditor protection. So those are the holdings you put into the bank or the mutual fund company as a mutual fund. And for us, we do say, well, in such a changing market, we say, well, segregated fund could be the good choices because there's many benefits that mutual fund doesn't have. Even the same fund, you can choose like a purchase from the bank, or you can purchase from an insurance company. And then segregated fund is a protection of your principal. At the maturity day and upon death, there's a guarantee, either 75% or 100%. They can reset your guaranteed amount. Means what? They can also lock in some profits. Then it can bypass the probate and avoid all the legal fees, accounting fees, surrender fees at the point of what? Death. Because if the person died without a proper will, there will be a very long procedure. But here, they can avoid those long procedure and there's no fees because segregated fund will pay to the beneficiary within 7 to 10 working days. And then a good thing is that to keep the privacy of your money and also have a creditor protection. Even someone or the creditors claim the amount, this amount is already being protected, so it can go to the beneficiary. And let's look at some example about a segregated fund. This is 100% like a protection of the principal at 2 points, maturity and death. And we show this as a reset function. Let's say this person put in 100,000. Because we have the reset function, so the principal guarantee move up to 140,000. The reason is that those last 10 years, this person gained a lot of money, right? And God forbid at this point, for example, at the age of 65, the person passed away. Very sad, okay? And then at that point, let's say very unluckily, the market drops. The market value is just like a 75%. However, if the person put the money into the segregated fund, then how much this person will get? Because we give him 100% guarantee, then this person will have 140,000 and issued by the insurance company and to the beneficiary within 7 to 10 days. So it's a very liquid at the point of a tragedy happen. Okay, so that shows you like what's the advantage of putting money into such a safe place. And let's simply look at the investment side. And we say, well, you can choose from a growth portfolio, balanced portfolio, or conservative portfolio. Why I would like to show you this like 86 years long-term investment. If you stay invested, even you just put in $1,000, like this is a long lifetime, right? We can see this is one conclusion. You always can make money and you can beat inflation as long as you stay invested in the long run. And also the market ups and downs, there's always risk. Okay, we know that's the fact. But the good news is that those are the bull market, the period of time and the growth of the market is always like better than those bear markets. Like the bull market, they last longer. Bear market, they might last like 1 year and a half or something like that, or a few months. And so that helped us like you have a more chance to make money than lose your money. And here we come back to our rule of 72 and the principle of investment. So if you put into 3% conservative, 6% balance, or 12% like a growth portfolio. And here is the 8 wonders of the world. And who discovered this? Albert Einstein. It's a very simple formula just to show you how money works. It says 72 divided by the average rate of return equal to how many years your money can double. If you put it too conservative, your money still double, but double slowly every 24 years. So at the age of 68, you will have 8,000. If you put into your 6% balanced portfolio, at the age of 68, you will have 32,000 because the money double every 12 years. And of course, if you are able to take some risk, put into more growth portfolio, average rate of return 12%, and then your money doubles 6 years, every 6 years. And at the retirement, you will have over $250,000. So this is really the principle of like, how to say, the general rule of investment, why you need to invest money. And we also would like to show you a different form of investment. Previous one is the lump sum. Here I would say, well, I can also do it monthly contribution. Is that right? This applies to different saving and investment accounts. Tax-free saving account, RSP, FHSA. This is our focus today, or non-registered account. Okay, doesn't matter what account you open, it's just a container, right? And you put into the portfolio, let's say average rate of return 7%, balanced portfolio. The more you sow, the more you reap. So this is the law of nature. Let's say every month you put 200,000, or every month you put in 300,000 or 500,000. Let's look at your retirement. There will be quite a huge difference, right? So if you can put more, you can have a very good portfolio at the age of like 65 after you retire or after you work for 30 years, okay? And here is a curve to show you to open an FHSA account. Let's say every month I put in $600. So you contribute $7,200 this year. It's not exceeding 8,000 maximum room, right? If you continue to do this 15 years, we also show you the average rate of return, 7%. And then what happened is that you can accumulate quite a decent amount. It's 6 figures, 187,000. Okay, let's say this is a person is only 20 years old, and he still go to study, looking for a job, changing city, and at the age of 35, 15 years later, and he said, oh, now I'm ready to settle down. I want to get married, to buy my property. And with this 6-figure decent amount, like a down payment, and he can buy a very good property, right? So here, the point is that just let you know that your money will not grow in such a smooth line, okay? It will always goes like ups and downs, ups and downs, and ups and downs. But we just show you the average return 7%, okay? And we say, well, the wealth formula, how to create wealth, there's a lot of factors into this. We need to put into our initial investment. We need time to accumulate money. We cannot time the money, the market, right? But we know there's a time value of money. And then we also need to watch and see our rate of return. We need to beat the inflation, and also we need to consider the tax consequences. And then at the end, this is your wealth that you can accumulate. So it's quite a complex task. That's why you do need to find a good financial advisor to discuss this with the person and to find a suitable solution and really, truly, and create wealth along the years. A quick example, okay? So let's, for example, our work, we always would like to look out for the investment that can outperform the market. For example, this is the historical data. The gray line is the Standard & Poor and TSX Composite Index. Means what? It is US market and Canadian market combined. And we always would like to look how the funds that are similar behave in a way like the red line. Okay. Why you need an advisor? The reason is that with the guidance of professionals, you can have more money into your portfolio. Another example, I just would like to show you the reset function of a segregated fund. We show you the difference between segregated fund and mutual fund. And then we say, well, this is an example. The computer do the reset every month. Let's say the person put in 100,000. As long as the market going up, and this computer will lock the principal, guarantee level up. So at the end of the year, the person's 100,000 will become 105,400, and the guarantee amount will lock here. Means what? For this year's investment, not just the initial deposit will be guaranteed amount, okay? Also including the 5.4% of the profit will be guaranteed, okay? And here's another example. It's also a historical data from 2013 to 2021. It's a long-term investment. So you can see from here, this money is more than double. So this is pretty much just show you, is it achievable, like a rule of 72? Yeah, when you see those real like performance of the market, you see that it's achievable. Also, mind you, this is what happened. There's a big dip here. It's a 2020 March when the COVID hits, like everybody was a big, panic at that time. But however, the market bounced back. Okay, so you see the curve, like an average rate of return close to 10%. Okay, but of course, during this course of investment, you see an up and downs, and that's the reality. All right, so let's look at like all our Canadian partners, like product providers here. With our company, we offer a variety of choices. We have multiple business partners, including banks, including the funds company. We also have insurance company. So we can always be able to find a suitable solution for our clients. And then, so that is all I would like to share with you about the FHSA, First Home Saving Account. And this is my contact information. My name is Hailing, and my cell phone number, you can call me or email me, and worldfinancialgroup.com. This is our company's official website. Feel free to find more information.